Thanks everyone. So the budget in May last year contained the most changes to superannuation since 2006. While the potentially unpopular changes were the ones to get the most airplay, like the $1.6 million cap and the proposed but now discontinued $500,000 lifetime non-concessional contribution cap, not all the changes were negative. There were actually some positives, such as the ability to make catch-up contributions over a 5-year period. Before we discuss in a bit more detail some of the key changes, it's important to point out that the reforms have no impact on the taxing treatment of money withdrawn from super. In other words, pensions and lump sums received by someone after the age of 60 are still tax-free to the recipient when they come from a tax source. Tonight I plan to pose some hypothetical questions, based on actual ones we've received, as Michael mentioned, in relation to the changes, and provide some insight into how the changes might apply to the question and other issues that may arise. So our first question. Our SMSF has a balance of $2.4 million. Are we affected by the changes? A valid question. The answer to this is most likely, but how much? It depends. Depends on how much is in each member's account. Are any of the members in pension phase? If there is a pension in place, is it reversionary? Is there a transition to retirement income stream in existence? Are there significant unrealised capital gains in the fund? Are the members continuing to make contributions? And do the members have any other super, for example, a defined benefit pension? For starters, I'll explain the transfer balance cap. This cap of $1.6 million places a limit on the amount of capital retained in or transferred to the retirement phase. Why is that relevant? Because the earnings on this balance are exempt from income tax, whereas the income on the portion of the fund not supporting a retirement pension, such as an accumulation balance or a transition to retirement pension, will attract 15% tax. This doesn't mean that any excess over $1.6 million has to be withdrawn from super, although that may be entirely appropriate depending on the circumstances. The excess can remain in super in an accumulation account. For high income earners, this may still be an attractive option as the 15% rate is lower than their personal marginal tax rate. Each individual has their own transfer balance cap. The cap itself is indexed in increments of $100,000 in line with inflation. There are certain things that are considered debits and credits against the cap, but importantly, investment earnings or pension payments are not. So if a pension grows to, say, $1.9 million, you're not required to remove the $300,000 from the pension account. And likewise, if a pension falls in value to $1.2 million, the extra $400,000 can't be transferred to a retirement pension. So if our members from the fund from before have equal balances in account-based pensions, the transfer balance cap is unlikely to affect them initially. Should they add another retirement pension, assuming they're able to still contribute to super, then the additional amount will be assessed against the cap. This would also be the case if a spouse passed away and had nominated the surviving spouse to receive their pension on death. But more on that topic later. If, say, the balances were $1.9 million and $500,000 instead, then $300,000 would need to be transferred out of the pension and back to the member's accumulation account. Practically, this has to occur prior to the 30th of June 2017. I touched on defined benefit pensions earlier. These are assessed differently under the transfer balance cap. The annual pension entitlement is multiplied by 16 to work out how much is counted towards the cap. If someone has a defined benefit pension, this will be counted first towards the transfer balance cap before any other super, including an SMSF. Another looming deadline is the inability to make non-concessional contributions after the 1st of July, where a member's total superannuation balance is over $1.6 million. So are there any opportunities to manage these situations? Obviously, it will depend on the circumstances, but some things that could be considered are: is there any scope to withdraw excess amounts from super and recontribute them for the spouse? Are there additional funds outside super that could be contributed in before the 30th of June? Or does it make sense to retain some wealth outside of super to access the tax-free thresholds? Is it worth stopping a retirement pension until permanently retiring? The fund will now be paying tax on the earnings of that pension, so it may seem to be the logical option. But what if that member was relying on the income for cash flow or for paying down debt? If you're currently receiving a transition to retirement income stream, would this cause your retirement plans to be brought forward? As you can see, there are numerous things to consider and everyone's circumstances are different. I'm aged 53. How much can I contribute to super? Would anyone like to have a shot at answering this question? So over 50s can still contribute up to $35,000 this financial year, or $30,000 if you're under 50. But from the 1st of July, the concessional contribution cap drops to $25,000 for all taxpayers. Amounts exceeding the cap are treated as assessable income to the individual, and the individual wears the tax liability. On the non-concessional contributions side, so these are the after-tax contributions, the limit is still $180,000, or using the bring forward rule, $540,000. From July, this drops to $100,000 or $300,000 using the bring forward. Just a reminder that the bring forward is not available for those over the age of 65. So one of the new measures introduced, which will not take effect until the 1st of July 2018, is the ability for taxpayers with interrupted work patterns or lumpy cash flow to make catch-up contributions if their balance is under $500,000. So if someone doesn't fully utilise the concessional contributions cap in a year, the unused amount up to the cap can be carried forward for up to 5 years. As you can imagine, this is going to make timely record keeping critical to determine eligibility where people are getting close to the $500,000 balance limit. Another welcome change was the ability for all taxpayers under 65 to make personal super contributions, and that they're deductible. We know this as the removal of the 10% test, which has made it difficult for those who are partially employed for wages and partially self-employed to make tax-deductible contributions to super. This reform will also benefit those whose employer does not offer salary sacrificing to their employees. One thing we were hoping for was the removal of the work test. For anyone over the age of 65 wanting to make a contribution to super, they must first meet a work test. So just a reminder what the work test is. It is that it requires an individual to have gainful employment or self-employment for at least 40 hours in a 30-day period. Finally, any government employees who are members of the SSS scheme will need to be aware that contributions to this fund will now be counted towards the contribution cap. So that's a fairly major change for the people affected by that. I earn $150,000 in wages and get dividends from my company of $100,000. Will the super reforms affect me? The short answer to this is yes. The Division 293 tax, introduced a few years ago, is an additional tax of up to 15% on super contributions, where someone's income and super contributions is over the threshold. Currently, this threshold is $300,000, but from the 1st of July, it drops to $250,000. So what's included? Firstly, assessable income, then salary sacrifice contributions, reportable fringe benefits, investment losses, and superannuation guarantee contributions all count. The tax is then determined by how much of the contributions exceed the threshold. The taxpayer in the question already has income of $250,000, so any level of concessional contributions will be over this threshold. At a minimum, there would be super guarantee contributions paid by the employer of around $14,000. This would result in additional tax of $2,100, which is 15% of the $14,000. So this tax is different to the contributions tax, which is paid by the fund, because the tax is assessed to the individual, and quite often it occurs simultaneously with the lodgement of the personal tax return. The taxpayer then has the option of having the tax paid by the fund or not. For the next question, we're going to assume that we've hitched a ride in Doc Brown's DeLorean, and it's now February 2018. My SMSF owns a dental practice property, as well as shares and some cash. My wife and I were both receiving account-based pensions of $1.6 million when she passed away in January 2018. What happens with her pension now? In order to answer this question, we need more information. For starters, was the pension reversionary? This is where a beneficiary was nominated at the commencement of the pension. If it was not reversionary, then there is discretion as to whether to pay the death benefits as a lump sum or as a pension. There is an important distinction between the two types. In the case of a reversionary pension, the value of the deceased member's pension on the date of death automatically transfers to the spouse 12 months after. At this point, it will be assessed against the transfer balance cap of the recipient. As the recipient in this case has already used up their own transfer balance cap, they will now potentially be faced with an excess amount. There are consequences for having an excess, but we're not going to go into that tonight. If, on the other hand, the trustee has the discretion, then the balance of the deceased member's account on the date is the date that the benefit is paid or the pension is commenced, which may be before or after the 12-month period. So what options are available? When there is a surviving spouse and there is a desire or a need to keep the amount in super, say because the dental surgery made up 2/3 of the fund, the surviving member could commute their own pension back to an accumulation account and take on a death benefit pension from his spouse's balance. By doing so, there would be a debit against the member's transfer balance cap and then a subsequent credit. I'd like to point out here that another change that was introduced is that death benefits now will always remain a death benefit. What does this mean exactly? Death benefits can only be in the form of a pension to a dependent or a lump sum. Well, in the past, a person who was receiving a pension from their spouse could decide after a period of time to roll back the pension into accumulation, assuming they weren't relying on the pension for the income. Now a death benefit will always retain its nature as a death benefit. So if a pension was ceased, it would need to be paid out as a lump sum and leave the super system. So what if in addition to the pension, the wife had an accumulation balance of 1 million? So her total super balance was 2.6 million. In this case, only 1.6 million could potentially stay in super. The remaining 1 million would have to leave the super system as a lump sum death benefit. What if there's not enough liquid investments to pay the lump sum? What happens with the property? If all that remains is the property, will there be enough rental income to pay the pension payments into the future? So how does the capital gains tax relief work if my pension balance is currently over 1.6 million? This also applies if a fund has a transition to retirement pension. In order to prevent SMSF trustees from rushing out and selling and potentially rebuying the same investment, the government announced CGT relief for those impacted by the changes. So this is those who have pension balances of over 1.6 million or have a transition to retirement pension. So how this relief works depends on whether the fund is accounted for on a segregated or an unsegregated basis. An example of segregation, a very simple example, would be a single member fund who is only paying pension. Whereas an unsegregated fund means that the fund has members in both pension and accumulation phase. In practice, we find this to be the most common situation. It involves applying for an actuarial certificate to determine the exempt proportion of income each year. A simple example of an unsegregated fund would be a 2-member SMSF, one member with a pension of 2 million and the other with an accumulation balance of 1 million. In this situation, the exempt proportion would be 67%, so 2/3 of the fund's income would be exempt from tax currently. As a result of having to commute 400,000 of the pension on the 30th of June, the exempt proportion in the example would drop to 53%. So you can see that if there were large unrealised capital gains in the fund, how it would appear to be advantageous to apply the relief. But there are a number of things to consider. These include, what if the second member commences a retirement pension and the exempt percentage actually increases to 86%? What is the current unrealised capital gain on the investment, and is there further anticipated growth? Are there different parcels of the same shares, some with higher unrealised gain than others? The important thing to remember is that the relief applies, it can be as micro as per parcel. Are there any capital losses, either past, present or future? It's also important to note that the relief is not automatic and it's not compulsory. An election is made at the time of lodging the 2017 tax return, and once it is made, it is irrevocable. I'll explain that in a bit more detail soon. The fund is deemed to have sold the investment and then repurchased it for its current market price. So this can be tricky when we've got property or other unlisted investments. So once the hypothetical gain is calculated, the fund can either include it in their 2017 tax return or defer until the investment is eventually sold. But the capital gain to the 30th of June 2017 is now locked in. So to give you some idea of why the decision to apply for the relief is so complicated, we'll work through an example. I have assumed it's an unsegregated fund for this exercise and that its current, so pre-June, exempt proportion is 60%. Let's say the fund purchased 2,000 CBA shares in 2010 for $100,000. Not an unrealistic situation. And on the 30th of June 17, they are now worth $170,000. So we have an unrealised gain of $70,000. The trustees elect to apply the CGT relief and reset the cost base to $170,000. This also restarts the 12-month period for discount purposes. If there were no other gains or losses, then the gain of $70,000 is discounted by a third to $46,666. We then apply the exempt proportion to the gain, reducing it by $28,000 down to $18,666. So this amount can then either be included in the fund's tax return for that year or deferred until the CBA shares are sold. So let's say that the fund elected to defer the gain, and when the shares were sold in 2019, they had increased in value to $250,000, so a further gain of $80,000. We also know that the fund's exempt proportion has decreased to $20,000. After discount, the gain is $53,333. Then allowing for the fund's exempt proportion of 20%, the assessable gain is now $42,666. But we also have to now include the $18,666. So the total gain on disposal is $61,332. So we'll compare this to if the fund had chosen to not apply for the relief. The capital gain would be $100,000, which is 2/3 of 250 minus 100,000, of which 80,000 would be assessable using the 20% exempt proportion. In other words, the fund is actually better off by $2,800 tax, being the tax that they've saved by applying the relief. Another scenario to consider is what if the value of the CBA shares fell below $170,000? The fund would still have to bring the deferred gain to account, and this may be fully or partially offset by the loss, but it's not an ideal situation. However, if the fund's exempt proportion increased to, say, 80%, so using the example from before when the second member commenced a retirement pension, and the fund had elected to defer the gain of $18,666, the outcome would be an assessable gain of $29,333. Whereas if they had chosen not to apply for the relief, the gain would only be $20,000. So just to recap, CGT relief is optional. It's not compulsory. It is also not automatic. You actually have to make an election. So trustees need to work with their investment advisor, if they have one, and their administrator to identify the investments that are appropriate. And remember, once that election is made, it is irrevocable. So I hope I've given you some ideas of the issues leading up to and beyond the 30th of June. The reforms will affect different people in different ways, so it's important to stay informed and seek advice. Thanks very much for your time. I'll now hand back to Michael.